Namaste and a very good evening to everyone joining us. Welcome to today's webinar on Market Insights by UTI Mutual Fund. I'm Sonal Mittal, Product Specialist at UTI, and I'll be your host for the session. It's been an eventful first half of the year for markets. The AI theme continued to dominate global sentiments. Geopolitical tensions in the Middle East escalated sharply before easing with a ceasefire, and crude oil swung from above 100 US dollars a barrel to around $70 now as fears over the supply disruptions faded. Through all of this, India's growth story has stayed resilient. So, naturally, two questions are on every investor's mind right now. Where do markets go from here, and how should portfolios be positioned to navigate what's ahead? To help us answer both, I am delighted to welcome our speakers for today, who are perfectly placed to do just that. First, Mr. Vetri Subramaniam, our MD and CEO, who will share his perspective on the market outlook, the key macro trends in play, and the opportunities and risks investors should keep in mind. We are also joined by Mr. Karthik Raj Lakshmanan, Fund Manager at UTI. Karthik joined UTI in 2022 and currently manages our large cap strategy, multi cap strategy, and MNC fund. He brings over 21 years of experience across financial services and investment industry, having worked with institutions including Baroda BNP Paribas Asset Management, ICICI Bank, Goldman Sachs, and ICICI Prudential AMC. He is a chartered accountant and CFA charter holder. Karthik will walk us through the UTI Multi Cap Fund, its investment philosophy, portfolio positioning, and how it is navigating the current market environment. Vetri, Karthik, thank you both for being here today. Let me now invite Vetri into the conversation to kick us off.
Good evening, everybody. Thank you for joining us here on this edition of the Monthly Market Insight. And of course, as usual, Sonal has put together a fantastic presentation, which will give us the opportunity to showcase many of the thoughts and questions that you all would have about the markets. And we do this always based on the kind of questions and inputs you might have, because those are the eternal questions which sometimes face us when we try to figure out our portfolio positioning. So without any further ado, I'll hand it back to Sonal and we'll get going with today's presentation.
Sure, thank you, Vetri. Let me start with one of the biggest themes that has shaped global markets over the last couple of years. The AI-led rally in US technology stocks has been remarkable and has attracted investors' attention from across the world. How has this AI-led boom in US influenced global capital flows?
That's a great question, Sonal. And, I think one of the things that investors perhaps are not aware of is that the US equity market is currently dominating the scenario as far as we talk about, the global equity markets, or rather the weightage of US equities in global equity markets. But first, let's look at these two charts. So if you look at the left-hand side, this chart shows you the inflows that have been happening into US equities. And what you will see is that ever since the pandemic started, in general, flows into the US have been positive. And then particularly this year, which is really 2026, the annualized run rate of inflows is about to set a new record. So really 24, 25, 26 has been the period where this AI boom has come to the forefront, and that has resulted in significant flows into US equities. To those of you who are not aware, US equities now currently account for almost 65% of global equity benchmarks. At the worst part of the global financial crisis, this number was down to barely 45%. So really, US equities have been dominant in terms of their share of global markets, and a lot of this has been led by the AI momentum, which accelerated in 2026. And if you look at the chart on the right hand side, this actually shows you the inflows into tech stocks, which you can see in the early part were very weak, and then suddenly it goes ballistic in this 2025-26 period. So really the entire flow has gone into the US. And Sonal, that's why I very often say that the US equity market is literally sucking the oxygen out of the room for everybody else, because they have taken in so much of the capital that is available around the world, and this has resulted in them being almost two-thirds of global equity indices. And you can see the remarkable flows that they've enjoyed in the chart on the right side.
That's an interesting point, Vetri. That brings me to my next question. We have seen hyperscalers announce unprecedented levels of capital expenditures. What's driving this surge in capex?
So Sonal, there are multiple factors, and obviously the very the one that all of us are aware of is the fact that everybody is rushing to get ahead of the curve in the AI boom, and therefore there is significant investment that is happening. However, remember, whenever the significant investment happens, that amounts to high demand. High demand results in a shortage of the equipment that goes into those capital investments that are happening, and that results in capex cost escalation. So as a result of that, you actually now have a shortage of memory chips across the world, and you can see that here on the right hand side when it slumps into a deficit. And as a result of that, the price of these memory chips is going up dramatically, which is what we call DRAM and NAND. So you can see that these have now gone into deficit. Their prices are going up significantly. So in addition to the fact that there is obviously more investment that the hyperscalers are doing, the increase in the cost of equipment means that their capex is also being inflated by the increase in the cost of DRAM and NAND chips. Now, those of you who are aware may have actually seen the recent announcement by Apple, where they effectively hiked the prices of many of their products because of a short supply of chips. And in fact, they are seeking special permission from the US government to now buy chips from a Chinese company, which otherwise they were barred from doing. And the reason they are trying to do that is this shortage problem. So this shortage problem of chips is creating an inflation problem as well, both in things that you would consider part of regular expenditure as well as capex expenditure, and that is what is partly reflected in this slide. Yeah, so this is another interesting chart, and this really shows you the change in thought process which is happening in global markets. And you can see over here that the bloom, that the what do you call it? The MAG 7. So the MAG 7 is that white line, which actually is now currently underperforming. It is actually underperforming the S&P 500 total return index. So this is the S&P 500. This is the MAG 7, which is actually underperforming. Now, why is it underperforming? Because the hyperscalers are doing massive amount of capex. The hyperscalers are what is captured in the Bloomberg Magnificent 7 TRI. And where are they making their investments? They are making their investments by buying products from the companies which are selling them the picks and shovels. So that's companies like Micron, companies like SK Hynix, like Samsung. So they are transferring their expenditure to these companies who are not necessarily making the high-end stuff, but this is stuff that the hyperscalers need. So because of this investment, what you are seeing now is the stock prices of the Magnificent 7 is not doing anything, but the stock prices of the SOX index, which is the companies which make the supplies, is going through the roof. So those companies are up 101% vis-a-vis a mere 1.74% rise for the hyperscalers, which are underperforming the S&P 500, which is actually up 10%. So if you remember, most of 24 and 25, we talked about the MAX 7 driving the US market. They are still driving the boom in investment, but their stock prices are now starting to underperform because people have gone to the second derivative, which is they're saying, okay, it's great that they're doing the capex, but what kind of returns will they make on the capex that they are doing? And people are starting to worry about that. And that is why those stocks are currently underperforming. Whereas the companies which are selling the products which are benefiting from the capex to these hyperscalers, their stocks are going through the roof because their cash flows have turned hugely positive.
Your battery. So while the AI continues to reshape corporate investments, the macro environment remains equally important for markets. So let's turn to another key driver, US monetary policy. What's your outlook for US interest rates? Do you see Federal Reserve raising rates at any point during calendar year 2026?
Right. So, Sonal, I think there is a little bit of a change in what we would call the expectations of central bank actions, and that's visible in this chart over here. This is a chart of central bank rate hikes minus the cuts on a 3-month rolling basis, and it includes both developed and emerging markets. And what you can see is that this chart, which was in a rate cut territory, is now actually moved to the baseline, which means more central banks are now indicating possibility of hikes as opposed to cuts. As far as the US Federal Reserve is concerned, the market now expects the US Federal Reserve to actually to increase rates in CY26. So at the beginning of 2026 in January, the markets actually believed that the Fed might cut 1 or 2 times during 2026. But as we speak today, the markets now expect that the US Federal Reserve may deliver one rate hike of 25 bips in the current year. Why might they do this? One, inflation is continuing to remain way above their comfort zone. Remember, their target is 2%. Inflation by all measures is running above that level. Some of the chip-based inflation continues to feed into their system, and supply disruptions as well have caused their inflation to be higher. So this is something which is a reversal in trend where we started 2026 thinking about rate cuts, but now we are expecting more of rate hikes rather than rate cuts. I'll also add over here that I think we also have to look at the regime change which has happened in the US Federal Reserve. We now have a new chairman, which is the Warsh as the new chairman of the Federal Reserve. And his own thought process appears to suggest that one, he's a lot more of an inflation hawk based on his previous comments, though he actually believes that AI-induced productivity gains may cause inflation to be weak or remain low. But his bigger points of view relate to the fact that he does not believe in spoon feeding communication to the markets. In fact, his belief is that maybe they are over communicating and markets should behave more like grown-ups and not require constant guidance from the central bank. The second point on which he tends to differ from what has been the de facto system for, I would say, the last 2 decades is that he's also not in favor of the Fed increasing the size of its balance sheet. He feels the central bank's main instrument should be rate changes and not its balance sheet. Now, when you think about lesser guidance, when you think about more usage of rates and less usage of balance sheet, that would essentially mean more volatility in rates, and that would also perhaps lead to a higher risk premium or term premium in the rates. All of this, I think, is changing the expectation, particularly in terms of the US Federal Reserve policy. But we can also move to the next slide, Sonal, because I think, do we have one more? Okay, sorry. Yeah, we can move on to the next question.
Yeah. Let's turn our attention to India now. One of the important external variables for Indian economy is crude oil. Crude prices have taken a sharp U-turn and are now back to the pre-conflict levels. What does this mean for India? And in that backdrop, how do you see interest rate outlook for FY 2027?
So, Sonal, we are seeing a big divergence play out over here. Now, what you are seeing in this slide is India interest rates, and what we are looking at is the India interest rates over the last, effectively, I would say this is a 3 month odd period. And you can see what the change in yields has been over this period. Essentially, all the yields in India have trended to go lower over this period. And therefore, this is very different from the pattern that we saw in the US, where in the US actually yields have tended to move higher because there have been concerns about what happens to US Federal Reserve policy. And remember, their inflation has stayed above the comfort zone, whereas in India, be it treasury bills, be it certificate of deposit, be it government bonds, be it corporate bonds, in all cases the yields have come down on average about 20 basis points. Whereas in the US, actually yields have not cooled down too much. In fact, if you look at the US government bond yields today as compared to 3 months ago, the yields have actually moved higher. This is very different as compared to India, where you can see across the board government bond yields have actually dropped and come down. And we can see elements of this in the next slide as well, which captures this divergence in behavior. Now, what we are looking at this slide is bond yield differentials. So we are looking at the difference in bond yields between the India and US, right? So we are comparing India and US and looking at which way is the differential going. Now, first we need to look at the inflation differential. That's basically this blue line. So you can see the blue line, and over time you can see our gap in terms of inflation is relative to the US is actually coming down. So go back about 15 years, the gap was very high, and increasingly the gap relative to the US is much, much smaller. Now, we can convert this into looking at the difference in bond yield. So what is the US bond yield? What is the India bond yield? And you can see even over there, over time, there is a general downward drift which is happening in the bond yield. So the bond yield differential was as high as 6% if you go back in history to 2012, 2013. We are now at some of our tightest yields in terms of the differential between US bonds and India. But the reason this differential is so low is that our inflation differential is also so much lower compared to what it used to be in the past. So yes, bond differentials vis-a-vis the US has come down, but I would argue that this is a function of the inflation differential coming down. And finally, just given the way India has managed to tackle the recent increase in crude prices through a combination of fiscal and other measures, and given that it has so far proved to be temporary, what that means is that India's CPI could remain in the comfort zone. So unlike the US, where markets are now discounting a rate increase, in India, the base case remains that the central bank will not have to increase rates, and the rate differential looks comfortable, even though it is much lower than its historical track record, but that is in line with the decrease in the inflation differential.
Sure. Thank you, Vetri. That was an insightful perspective. Another important variable for India's economy is monsoon. How has this year's monsoon progressed, and what implications could it have for the economy and markets?
Sure, Sonal. In a lighter vein, till 15 days ago, one of the things I used to do every day in the morning is open Twitter and not look for the US markets, but look for the post by the BMC. Because every day in the morning, BMC posts the reservoir level of the 7 lakes which supply water to Bombay. Yes, I admit I have obviously bias towards Bombay because that's where I live. And that number had come down to 5%. So the lakes were running at 5% of their capacity 2 weeks ago. But with the phenomenal rains that we got 1 week back, it has now climbed to over 40% of reservoir capacity. So if anybody wants to understand cyclicality in any data point, it's a great example of how 10 days of rain moved the data point from 5% of capacity to 45% of capacity. But the bottom line is that there is a deficit. in terms of the rainfall. You can see that over here in the blue line. This is the deficit as compared to what should have been the normal rain pattern. So there is a deficit over there, and that is what is tracked in that red line. The good news is that when you look at the reservoir levels are still reasonably comfortable. So yes, there is some divergence from the nominal level, but remember, it is still running at 0%. So from the normal level of storage, there is not much of a divergence, which is why this black line and blue line are at the same level here, whereas here there is a gap between the black line and the blue line. So the left side is telling you that rainfalls are deficient, the right side is telling you that our storage levels are comfortable, so there is not much of a deviation. Having said that, remember that India gets its rains, or rather its agriculture output, from two crops, the Kharif crop and the Rabi crop. The Kharif is more impacted by monsoon levels. The Rabi is less impacted by monsoon, and is also a function of storage. So from that point of view, I would say the concern as of now is still slightly low, despite the fact that the monsoons are off to a weak start. We can't completely eliminate the concern because this is supposed to be a super El Nino year. So fingers crossed over there, Sonal. But I think, so far, touch wood, we don't have to worry too much. But I would also point out, if we move to the next slide, that frankly, we discuss too much about the monsoon. You look at the chart on the left-hand side, which looks at monsoons and real, gross value added numbers. And you can look over here in some of the, years where we've had normal monsoon. And 2Q is when the monsoon happens, and then after that you've got the other quarters. Now look at the outcomes in a normal year. In a normal year, again, the outcomes that happen in terms of GVA in these other, quarters is only slightly lower than where it is during the monsoon quarter. Secondly, look at it when it is deficient. So what happens to gross value added, which is another way of looking at GDP, in the quarters where you actually have a deficient monsoon? It is not too different from these values. So simple point to make over here is that the impact of the monsoon, certainly our farmer brethren and brothers and sisters tend to feel it because it impacts their output for that year. But when you take the aggregate economy, because agriculture as a percentage of the economy is a much smaller number, it does not really impact the economy as much. And that is the story which you see in this slide on the left-hand side. Whether the monsoon is normal, below normal, or deficient, you are not seeing great variation. There is some variation, but not a great variation in the level of output. What about the stock market? On the right side, we have shown you the El Nino years. What happens in the El Nino years in terms of the performance of the market in absolute terms, and what happens relative to the MSCI Emerging Market Index. And you can see here in some El Nino years, the market has actually done well. In some El Nino years, it has done poorly. Relative to the EM benchmark, it has actually tended to do well in many years where you've actually had a monsoon deficiency. Net, there is no clear pattern between whether you, can try to convert the monsoon into its impact on the economy or onto the markets. Having said that, I will continue to check the data to see what the impact of the reservoir levels in Mumbai is, because it would certainly have impact on the availability of water for all of us who live in the city, drinking water and water for other purposes. But as far as the impact on the markets and economy is concerned, I would actually submit that the historical data is telling us that it doesn't really have enough of a discernible pattern for us to take investment decisions based on this.
That's helpful, Vetri. I would now like to touch upon another closely watched macro variable, the rupee. We have seen the rupee depreciate over the past year. How do you assess it from a RER perspective? And could measures like FCNR deposits provide meaningful support?
Sure. Good question, Sonal. But first of all, we should always understand what is the valuation metric telling us. And the best valuation metric that we have is the INR real exchange effective rate. And this is now telling us that as against the value of 101.7, we are now trading very cheap at 90.8. So this is, multiple standard deviations away from the mean. Based on this, I would say that the INR is very, very attractively valued. I don't know whether it will result in a sharp bounce back, maybe not because of the positions that are in place. But if you are looking to invest in India, then the rupee should not be a drag on your returns. If anything, rupee could actually add to your returns over the period of the next 2 to 3 or 5 years, simply because you are so far away from the base value. So I would say the rupee clearly looks undervalued in real exchange terms. You also mentioned, Sonal, about the FCNR and other schemes. So let's look at some data related to that. Now, remember, a lot of the schemes which were announced a few weeks ago by India, these are very similar to the schemes that were announced in 2013. Now, if you look at 2013, what you will see is that there was a significant collection which happened through the FCNR schemes, and FCNR schemes spiked by nearly 2% of bank deposits in 2013. So, we could perhaps expect the current schemes, because they are very similar to the schemes of 2013, to have a similar impact of about 2% of bank deposits, and that could result in inflows both through FCNRB mobilization as well as the FX loan scheme that the RBI announced. Both these put together could bring in $50 to $60 billion of money. Now, because these will directly go into the swap window with RBI, I don't expect to see this impacting the market rates, but certainly it will allow RBI a lot of comfort in terms of managing the currency. Now, some people have raised the question that why hasn't the rupee appreciated like it happened in 2013, where it appreciated after the announcement. But remember, in 2013, there was a vertical fall in the value of the rupee. So you get a vertical fall, and that causes the bounce back. So you see a massive V effect. This time around, actually, the fall was a lot more moderate, and which is why even the bounce back has been a lot more moderate. So just think of it like dropping a tennis ball. When you drop it from a great height, it bounces back a lot more sharply. Here, the fall was much more muted, and therefore even the bounce back has been a lot more muted. But I do think you will see a lot of stability in the rupee going ahead.
Thank you, Vetri. We've spoken about the global backdrop and domestic macro environment. Let's now bring discussion back to equity markets. One question we hear quite often from investors is around mid and small caps. How do you see this segment after recent outperformance? And maybe later, it would be great if you could touch upon the earnings outlook, current valuations, and what our proprietary equity valuation index is signaling today.
Sure.
Over to you.
Sure. Thanks, Sonal. So I must say, it's been a surprise in terms of the bounce back that we've seen in the mid and small caps. You can see their 1 and 2 year returns over here. And this has resulted in their 2 year returns nudging ahead of where the large cap is. This would not have been my base case. My base case was that the large caps would most probably outperform the mid and small caps. Not happened so far. Doesn't mean it will never happen. I would still say, based on where valuations are, I would continue to believe that you will see some mean reversion over here, with the large caps tending to do better than where the mid and small caps have. But as of now, on a 2 year basis, you are starting to see some outperformance by mid and smalls compared to the large caps. If we move on to the next slide, here we are talking about the EPS growth for the Nifty 50. Remember, we had this massive performance in terms of EPS growth, literally coming out of the pandemic. There was a 16% CAGR between 2020 and 2024. We saw this strong growth in EPS. We've had 2 moderate years in terms of EPS, which is 25 and 26. And now going into 27, the expectation is for 14% growth in EPS, so much better than the last 2 years. given the fact that some of these war related problems seem to have taken a little bit of the backseat, even though technically we're still not clear if there is a ceasefire, I would say right now maybe it's 50-50% in terms of probability, in terms of whether we can get to that 14% number in terms of earnings growth expectation for 27. One reason why this earnings growth may be within reach is that this year nominal growth in GDP is expected to be better, which will also drive nominal sales growth better, and that could be a positive factor in terms of earnings growth, though I would worry about margin related negative surprises. Moving on to the next slide, this looks at company performance. Now remember, this is not the aggregate number. Company earnings and revenues are not growing by 62% and 56%. What we are looking for is how many companies in the Nifty 500 are managing to grow higher than 10% year on year. That number is improving as nominal GDP growth improves. In Q4 FY26, 62% of the companies had revenue growth higher than 10%. 56% of the companies had PAT growth higher than 10%. So that number is certainly on an improving trend, and that could be one of the numbers that growth in nominal GDP continues to support. Moving on to the next slide, we now start looking at the valuations. These are the standard slides. The white zone is the fair value zone. So where is the Nifty 50, which is a barometer of large cap valuations trading? It's trading in that white zone, which is the fair value zone. This is based on trailing PE. On the right side, we've got forward PE. Once again, it's trading in the white zone, above the long-term average line, but in the white zone, which I would say is the fair valuation zone. The trailing PE multiple is much closer, of course, to the long-term average. Now we've got the price to book. Now in the price to book, again, the white zone is the fair value zone. In this case, it is actually trading below the long-term average and only slightly above what we would call the cheap zone. So certainly a lot of comfort one can take from price to book ratio for the large caps, and also comforting because currently the return on equity of the Nifty, which is 50, which is the large caps, is more at the upper end of its historical zone. So in the large caps, there is a significant amount of valuation comfort. On the next slide, we've got the mid cap and the small cap in terms of price to book. I would say much less comfort here. The mid caps trading in the expensive zone. Small caps, not so much. In fact, they briefly came into the fair value zone, but I would still say relative to their history, they are trading in the expensive zone. And remember, relative to the large caps, at 4.78 times book and 3.74 times book, both numbers are more expensive than where large caps are. So certainly more comfort in the large caps. Quickly moving through to the next slide. This is where we compare equities and bonds. This is the historical average. This is where bonds become a lot more attractive. This line is moving up closer and closer towards that baseline, but still in territory where parameters along with the dividend yield into our valuation model. That is what you will see on the next slide, which is UTI's proprietary equity valuation index. What you will see in this is that this index, which is a combination of all these metrics, is currently trading in the increase equity allocation zone. And remember, there was a long period of time where this indicator was trading in the decrease equity allocation, or increase in equity only through STPs for a very long period of time. We have now seen the drop into the cheap zone. So certainly there is some reason to believe that now investors can increase equity allocation, though we would still argue for it to be done in a staggered fashion at this point of time. So this is what the equity valuation index is telling us. And this is the kind of outcomes you can expect when you are in different zones. Now we are in that increased equity allocation zone. 208 times out of the history that we have, the market has traded in this zone. This is more than almost 700 observations. Average 1-year return is 14%. The negative return when you buy the market in this area is only 7% of the time. and 56% of the time the return is higher than 12%. That is why we think the odds are favorable, and that goes into this light green zone, which is called the increase equity allocation zone. So that's what our equity valuation index is telling us. And remember, that is a driver of the allocation to equity in most of our managed asset allocation strategies, be it the equity savings, the multi-asset allocation fund, or the balanced asset allocation fund. So finally, this is a summary of everything that I've talked about. US markets now expect a rate hike in CY26. The regime change in the US Federal Reserve, all of these things put together, we think is likely to increase bond market volatility, and it is likely to increase term premiums. There are some signs of fatigue, if not a crack in the performance of the Mag 7 hyperscalers. I showed you the chart on that. What is doing well? The companies which are selling the picks and shovels to the hyperscalers, those are the companies which are doing well, which is really the SOX index. The monsoon we talked about, it's off to a weak start, but its impact on economic output and also its impact on markets is all over the place. So I don't really treat this anymore as being the defining factor in determining which way markets will behave. It's one of the inputs, and in fact, it's a very low correlation with market trajectory or GDP growth and earnings trajectory. There is some reason to believe that in India, policy rates may hold steady because of the way we've managed to navigate this crisis. Q1 FY27 results are expected to show double-digit growth, continuing the trend that we saw in the previous quarter. FY27 growth expected in mid-teens, with some of these war concerns now in the rearview mirror. The risk to these estimates is lower than what I would have expected 2 months ago. Our equity allocation indicator is in the increased equity allocation zone. Hybrid funds, we think, are a great place to make lump sum allocations, not only because of what our equity valuation index is telling us, but also because we think fixed income yields are attractive. And if you need to manage asset allocation in your portfolio, a more efficient way for you to manage that asset allocation is to get the fixed income exposure through the hybrid funds into your asset allocation. So that's the reason to look at that. In addition, of course, you could look at investing in large cap funds, which is where our bias remains positively inclined as compared to mid caps and small caps. Value has been a strong outperformer more than 5 years. We've been saying this for a while, that mean reversion should take place. It hasn't, but again, based on historical patterns, we think there is a favorable possibility of mean reversion, and investors should take cognizance of that. So I'll halt over there, Sonal. I think we've covered a lot of the macro and a lot of the things that may have been on top of people's mind, but I'll hand it back to you, and you can now invite Karthik into the conversation.
Thank you, Vetri. That was extremely insightful and helped put current market environment into perspective. And I would like to invite Karthik into the discussion now. Karthik, welcome, and thank you for joining today.
Thank you so much.
Karthik, let me start by setting some context around the category itself. Investors today have several choices across large caps, mid caps, small caps, and flexi cap strategies. In that context, could you help us understand multi-cap as a strategy and where it fits into an investor's portfolio?
Yeah, thanks for the question, Sonal. So first, I'll talk about this from the UTI Multi Cap's prism, or the way we look at it. So we call it the 3S. The first S being style, which Vetri just mentioned, that in the last 5 years, we've seen value has outperformed quality. But there is always an alternating trend. Few years quality does well, and few years value does well. That's what we are seeing on the left-hand side. If we look at on the right-hand side, even on a monthly basis, there is change in the strategy that is working, whether it is quality or value. So as far as the multi-cap category is concerned, there is opportunity both on quality and value side. We will talk about that more in the subsequent slides. The second S being the sector. Again, if we look at for a pure large cap, the opportunity is a lot more in, say, private or PSU banks or oil and gas or auto OEMs. Whereas if you look at, say, capital markets or consumer durables or capital goods, there is a lot more opportunity in mid and small caps and not so much in large caps, because many of these companies are in the mid and small cap space. So for a pure large cap or a pure mid cap or a pure small cap fund manager, it is difficult for them to kind of participate in all sectors or subsectors. Whereas in a diversified category like multi-cap, there is opportunity to invest in any large, mid or small sector or a subsector. Now coming to the third S, which is the size. If we look at some of the other diversified comparable strategies, a strategy like FlexiCap, the actual funds holdings, if we look at, close to 60% is in large caps and about 40% is in mid and small caps. If we take that number for large and mid, it is 46 and 41, but small caps is far lower there. Whereas in a category like multi-cap, the average holding is almost 39% in large caps and 29 in mid caps and 32 in small cap. The point being that compared to other diversified funds, the exposure to both small caps and mid caps is higher in the multi-cap category. So that's where it is differentiated compared to a flexi-cap or a large and mid category as such. So these are the three S's, which is style, size, and sector.
Thanks, Karthik. That's a helpful perspective on the category. Investors also want to understand how such a strategy holds up over a longer periods of time and across different market environments. How does the returns and risk of multi-cap strategy compare versus broader categories such as flexi-cap?
Right. So when we look at this is the 3-year average rolling returns based on last 18, 19 years of data that we have. So based on that, these are all index returns. What we see is the large caps have lower volatility and lower returns. A flexi cap is somewhere closer to that. Multi-cap is the next, and mid and small caps have higher volatility and higher returns. Mid caps clearly has the highest returns, and volatility wise, probably it is slightly lower than small caps. So the point is that diversified category somehow is able to maximize both on the risks and the returns metrics. So it sits somewhere in the middle, trying to reduce the volatility or the risk, at the same time kind of giving returns better than pure large cap and slightly better than flexi cap as well. Now, if we come to the returns on a calendar year basis, 19 years data suggests that again the multi-cap index outperforms the NSE 500, which is the index for flexi cap, 12 out of 19 times. So, and you could clearly see that years when the markets do well, the mid and small caps outperform, and multi-cap, because of its higher exposure to mid and small cap, it tends to outperform the NSE 500. So to that extent, it gives that extra returns, which we can see in the subsequent slides. Even on a 3-year or a 5-year rolling returns basis, the average returns from the NSE 500 multi-cap index versus NSE 500 index is about close to 1.5%. It obviously comes with higher volatility because of the same higher exposure to mid and small caps. So on a risk-adjusted returns, maybe it is comparable with the flexi cap category, but on an absolute return basis, it tends to have higher returns over a longer period of time. And that is same reflected from a cumulative returns perspective as well. 10 lakh rupee invested can almost return 21x in the 20-year period. in multi-cap category, while the same number would be around 16 odd X in a pure Nifty 500 or a flexi cap category. So
That's a good
that's how
insight on. Yeah,
yeah.
sorry, go ahead, please.
I was just concluding that that's the just that multi-cap, because of higher mid and small caps, tends to have higher returns, obviously with higher volatility, because of which an investor needs to have a little longer horizon and higher risk appetite as far as the category is concerned.
Sure. Thank you, Karthik. That's a good insight on the longer term investment experience of the strategy. Could you take us through the investment strategy of UTI Multi Cap Fund, and how do you approach investing across large, mid, and small cap companies?
So if we look at our strategy, first on the right-hand side, like I said, I mean, the category requirement is that you need to have about 25% exposure to large, 25 to mid, and 25 to small. The remaining 25% can be allocated anywhere. The way we have articulated is that the range for large caps can be 40% plus or minus 10%, while for mid and small caps, it could be 30% plus or minus 5%, which means large cap weight could be anywhere from 30 to 50%, while mid and small caps could be anywhere from 25 to 35%. But over a longer period of time, the average allocation could be around that 40, 30, 30 between large, mid, and small. Coming to the way we look at it, like I mentioned, from a style perspective, the market has alternating trend. Few years value does well, few years quality does well. So as far as multi-cap is concerned, it is a blend strategy where we have a good allocation to quality or growth companies, where these companies have high ROCEs or have higher growth than the nominal GDP or the overall markets. And obviously they have higher valuations. But as long as the growth justifies or the ROC justifies those valuations, we tend to take them as part of our portfolio. And so on the other hand, value could be cyclical opportunities. These are companies which are low on price to book or price to earnings, EV/EBITDA, whichever metric. They could be lower because of lower growth or the cycle being against them. But as long as their long-term track record is good and they can deliver good, reasonable return ratios, those are also opportunities which we tend to identify. And on the extreme left, if we see, there are a few transformation opportunities. It could be in quality, it could be in value. Time and again, a sector or a company could be going through stress. And when they come out of that, there is a lot of money to be made because they are cheaply valued when they are in stress. So those opportunities are few and far between, but wherever we have those opportunities, we would like to kind of grab them. So it's a good blend of quality and value, and as well as whenever the opportunity presents, some transformation or turnaround cases. So overall, it's a blend strategy, and the idea is to pick up companies across sectors, across market cap, wherever there is an opportunity because of mispricing in the market, opportunity to create wealth. So it's a complete bottom-up approach, the way we look at constructing this portfolio. And market cap, as we discussed, it could have good exposure to large, mid, and small, and internal guardrails still kind of clearly provide us the construct as to sector weights and stock overweights and underweights. Based on that, the portfolio is constructed. And due to the nature, a large pool of companies to look at, the opportunities are a lot more, and to that extent, compared to our own other strategies, the portfolio turnover here could be higher. So in a gist, it is uniquely positioned compared to some of our other diversified categories because of the higher exposure to mid and small cap, and it's a disciplined strategy of following a blend as well as having a good allocation to all market capitalizations. And for this, we need a large research team because we would be tracking multiple companies or a very huge pool of companies beyond the NSE 500 or Nifty 500 as well. And for that, we clearly have one of the largest research team, experienced one at that as well. And this fund clearly provides portfolio diversification in every aspect, as we have discussed.
Karthik, coming to the current market environment, and particularly in the context of what Vetri spoke about earlier on the valuations and mid and small caps, could you share some insights on the current portfolio positioning of UTI Multi Cap Fund and how you are navigating the opportunities in the market today?
So, from the portfolio perspective, we have over 70% active share. The category is such that you're trying to pick up around 72 odd stocks from a pool of probably 700, 800 companies. Our own coverage is close to 500, 480 plus. And from that, we are selecting a handful of companies. So to that extent, the active share tends to be very high. So we have over 70% active share here, and well diversified one at that, so which you can see from the top 10 holdings, less than 30% in the top 10 holdings. So there is a strong middle layer of portfolio as well, where there is reasonable weightage. From a market capitalization perspective, as we discussed, it is close to the average that we've talked about. Large caps around 37 odd percent, mid caps around 29%, and small caps about 34 odd percent. From our score alpha metrics perspective, compared to the benchmark, whether it is C1 or R1, slightly it is higher than the benchmark, so slightly tilted more towards quality at this point in time. But when you look at the valuations parameter, it is almost close to the benchmark. The benchmark on a price to book is 3.2. The fund is at 3. Even on a price to earnings basis, it is slightly lower than the benchmark. The return ratios measured in terms of ROE is almost the same. If we come to the portfolio itself, the left-hand side table shows the top 15 holdings. You would see a lot of financial services or banks there. The construct of the even the larger universe itself is financial heavy, and to that extent you see a lot more financials here, besides our own liking for some of these large private banks. On the right hand side, you again see names which are not part of the Nifty 500, but reasonably sizable market caps and sizable businesses across sectors, right from capital goods, consumer durables, FMCG, and chemicals. If we go to the subsequent slide, so on the right hand side, you see the sector weights. Financial services, overall, it looks like an underweight because of our underweight in some of the mid-sized private banks, capital market companies, and NBFCs. But large private and insurance is something that we are clearly positive on. Besides that, healthcare is one space where both on the pharma as well as hospital diagnostic side, we are positive and we are overweight. And within consumer services is where we are overweight, while the consumer staples or FMCG is where we are underweight. On the left-hand side, you see the top 5 active weights or overweights. There are names in banks, capital goods, financial services, and similarly underweight also in similar sectors. Now, coming to the fund has been almost there over a year. In the last 1 year, if we see the allocation broadly for large cap has been around that 40% mark, and mid and small caps have been around that 30% mark. Even the latest month, the split is 36, 28, 32. From a number of stocks perspective, we've been around 70 odd, plus or minus 5 odd stocks there. So very well diversified in that. And like I explained, the top 10 stocks have less than 30% weight. So it is well diversified. Even the stocks beyond the top 10 also have reasonably good weight. And again, from a sector perspective, we are very well diversified, present in almost most of the sectors which are there in the benchmark. Active weights, like I mentioned, we have close to 70% on a stock level. Even on a sector level, if we look at it, is around 15 odd percent, which shows that at the sector level, we are trying to have good exposure across sectors and not taking very lopsided sector bits. So it's more stock picking bottom up basis, but across sectors, across market caps.
Thank you, Karthik. That was a very insightful discussion and gave us a good understanding of UTI Multi Cap Fund. We have also received several questions from our audience. So let's now move to the audience question and answers and take up as many questions as we can. Betty, my first question is for you. We've spoken extensively about AI opportunity in the US. However, the same is often posed as a relative disadvantage for India. So, where does India fit into the global AI value chain? Are there areas where Indian companies can meaningfully participate in the opportunity?
So Sonal, at this point of time, I think it is very valid to say that Indian companies are not involved in the AI-related investment boom, because neither are we investing as the hyperscalers are, and nor are we investing, nor are we benefiting from the spend of the hyperscalers in terms of providing the picks and shovels. But I think, that is a stock market question. If you ask me a question relating to the economy, I would submit that something like AI will bring fantastic benefits to the country at large, just like computerization brought significant advantages to this country, which was behind on its development journey as compared to other nations. Just like today, India is the biggest user of the internet, whether you look at it in terms of the number of users, you look at the number of things we are able to do using the digital rails that have been set up, including things like UPI. So we are the biggest beneficiaries of every large technology revolution in the world, which has effectively allowed people to become more productive or has lowered the cost of doing business. So I think it is incorrect to talk about India as a loser in AI. I think we will eventually benefit from the technology very significantly across the board. Having said that, there will be some business models that could get disrupted, and we are talking about the white collar jobs which dominate, things like IT services and the GCCs. But even over there, I think there will be some competencies and some businesses which over time will play a significant role. Because remember, every enterprise customer needs somebody to guide them through a technology transformation. And therefore, I think the nature of the role will change. But I do think that over time, India's white collar abilities in technology will also help us become the world's AI integrator of choice.
Sure. Betty, I would like to know next question also for you to take up. We've spoken about India's strong growth story, but one question that continues to come up is private sector capex. Are you seeing enough evidence of a broad-based private capex cycle finally taking off?
So I will again answer this the way I normally do, which is to say that India currently has a healthy rate of capex. It is not a super cycle of capex. The only caveat that I want to put is that the last time we saw a super cycle of capex, which was 2003, 2010 or 11, we then spent an entire decade cleaning up that mess. So be careful what you wish for in terms of wanting the private sector to go overboard. Having said that, I do think without doubt the private sector is a lot more cautious It got burnt during the last capex phase where they went very aggressively in 2003, 2012. So they're all being a lot more cautious. But honestly, one also has to worry about the impact of financial markets on decision making by entrepreneurs, to the extent that financial investors have placed an emphasis on balance sheet management, cash flow management, free cash flow generation. Entrepreneurs have actually responded to that tune by emphasizing these factors and not taking undue balance sheet risk or putting cash flow to risk by making large investments. So I do think we are running at a reasonably healthy level. Also, entrepreneurs are worried about the fracturing of the global economy, what it means for exports and import opportunities for them, and therefore some of the moderation in capex behavior is something that I would say is consistent across the world. The only area where entrepreneurs are not demonstrating animal spirits is in the AI boom. But Sonal, please look at that chart. That AI boom is resulting in the AI hyperscalers underperforming the benchmark. I admit it's only year to date, but it gives you a sense of eventually every investment boom has to meet the test of whether it creates return on capital.
Thank you, Vetri. Karthik, coming to you. How do you approach a great business when you like the company but simply can't justify the valuation? Do you wait, buy gradually, or move on to the next opportunity?
Thanks, Anand. Clearly, I mean, great businesses don't come cheap, especially in the markets like last few years. And to that extent, great business with good growth and good return ratios generally are very expensive. The way to look at it is compare it from a long-term growth perspective and what is the ask rate that the current price is building in and whether that is achievable. In many cases, it would be the ask rate would be much higher than the current price and achievable target. And to that extent, the way to participate in is position sizing. If we already own that stock, probably you reduce the exposure, have a lower exposure because the valuations are far higher. But if it is, say, 2x of the fair value, then obviously one has to completely exit. But otherwise, have a little exposure and monitor. And there could be a few quarters when things may not go their way. And that time, the valuations could give an opportunity to again add back.
I have a follow-up question. Fund managers often talk about what makes them buy a stock, but what makes you sell? What are the key triggers that tell you it's time to exit a company?
Just continuing from the previous answer, I mean, if the valuations tend to inch up, you clearly reduce the exposure. And if it is, say, multiple of the fair value, then obviously one has to exit. But other than that, in many cases, in structural businesses, it could be compounding stories where the reason to sell out in other than valuation would be if the business dynamics change, if the business model of a particular company is broken, or if there are some developments on the governance side where you find that the current price is not justified. So in most cases, our idea is buy and hold forever. But if the valuations are very expensive, that is one reason to sell. But in some businesses where the business gets disrupted or the company loses out, or there are some other reasons because of which it may not have the same growth that we initially envisaged, then you kind of move out, accept a mistake, or you exit the company.
Thank you, Karthik. Vetri, my next question is for you. There is a view that Indian markets may not necessarily see a sharp price correction, but could instead go through the period of time correction, allowing earnings to gradually catch up with valuations. Is that a scenario you see playing out?
Sure, Sonal. Simple answer to that is that, in equity markets, volatility and corrections are not a bug. They are a feature of the markets. Equity markets do not give you consistent year-on-year gains. There are periods where they give you extraordinary gains, and there are periods where they give you pain. Sometimes the pain comes by equity markets going nowhere in terms of price, even though on a valuation basis they could be derating. And sometimes the pain comes because equity valuations, equity prices slump significantly, bringing equity valuations bound back down to a cheap level. So it's impossible to say which of those two patterns the markets will use. But simplistically speaking, Sonal, what we already showed in that equity valuation index that we displayed earlier is that 2 years of going nowhere, at least in the large cap space, valuations have gone from the reduce equity allocation zone to the increase equity allocation zone. And that transition in the equity valuation index has happened because the equity markets have gone nowhere. So in a way, we are already going through that kind of a correction, which sometimes people call a time correction. But I would always say, don't just look at where price has gone, also look at where valuations have gone.
Thank you, Vetri. Karthik, coming to you. Private banks have been discussed as an attractive segment due to valuation comfort and growth potential. You are also holding an overweight position in private banks. What is your view? Do you believe private banks can lead the next leg of market performance?
So private banks, the long-term construct is simple that these are companies which are growing faster than the banking industry itself, and the banking industry itself tends to grow faster than the nominal GDP for a large part from a longer-term perspective as the credit penetration increases. So to that extent, we have companies growing faster than the industry and the industry growing faster than the nominal GDP. And these banks have continuously gained market share from zero over the last 3 odd decades with good return ratios, and they have a strong liability franchise. To that extent, the construct is good from a longer term perspective. In the last 3-4 years, what we've seen is when the overall markets valuations have moved up, this is one sector where the valuations have actually moved lower or below the long term average. And to that extent, even on a valuation front, they are attractive. And having said that, at this point in time, the asset quality issues are one of the lowest as far as the banking industry is concerned. So on all three parameters, they stack good, and that's where we are positive on the large private banks as a space.
Thank you, Karthik. I have a long line of questions, but in the interest of time, I will just take two questions. In fact, my last two questions are based on the experiences and learnings for both you and Karthik and Vetri. First question is for you, Karthik. Looking back at your experiences as a fund manager, what's one investing mistake or lesson that you has had the biggest influence on the way you manage money today?
Clearly, markets humble you a lot. I mean, there is no one method which works all the time, and there's no one formula which you can say, I will use this and that'll help me. But you need to kind of go back to the basics. And for example, I mean, for valuing any company, the clear metric is the incremental free cash flows that they are able to generate and the growth of that free cash flows, which is what in UTI, in our process, we look at in Score Alpha, whether it is ROCs or the cash flows. That is how we measure and evaluate these companies. And on the other hand, the markets do give a lot more importance to the near term 2-3 year growth, because long-term estimation has its own flaws, and to that extent, companies which are delivering here and now get rewarded disproportionately. One needs to evaluate them with a longer-term horizon, whether this is sustainable or it is something which would kind of mean reward.
Thank you, Karthik. Vetri, coming to you. What is one consensus view in markets today that you fundamentally disagree with?
Sonal, I can connect that back to the first question where we started. While I did say that the US is like a giant sucking machine, sucking all the oxygen out of the room for everybody else, I would actually say that the bet you might want to take is against the US, both against the equity market and against the currency. By the way, that doesn't mean I'm suggesting you go short. All I'm saying is that is the consensus trade, which is to invest in the US, both because of its currency and because of its strong stock market. I think both are, to my mind, near a peak argument. And particularly when it comes to the currency, Sonal, I would say that given the lack of discipline that they have shown, both in terms of managing the balance sheet, though the new Fed is talking about new things, but the lack of discipline on managing the fisc, the fact that inflation is running about the target and they're doing nothing about it, means that, I would rather be, for example, positive on the rupee versus the dollar rather than the other way around. So I would say non-consensus view, anti-US, anti-dollar, and actually positive the rupee.
Thank you very much, Vetri. That brings us to the end of today's session. Vetri, Karthik, thank you both for such an insightful conversation. We have covered a lot of ground today, the global macro environment, the key themes shaping markets, outlook for India, and finally, how UTI Multi Cap Fund is positioned to navigate opportunities across market caps. On behalf of UTI Mutual Fund, I would like to thank all of you for joining us today and your thoughtful questions through the session. I hope this discussion has helped you put current market environment into perspective and left you with some useful insights to carry forward. Thank you once again for your time. Stay focused and stay invested. Namaste.
Thank you. Thank you, everybody.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.